Why your business structure matters. Choosing the right legal structure is one of the most important decisions you'll make when starting a business in the US. It affects your taxes, liability, ownership flexibility, ability to raise capital, and long term growth strategy. Many entrepreneurs focus only on ease of formation or low startup costs. But the wrong structure can cost you thousands in extra taxes or expose you to unnecessary risk. Tax efficiency, asset protection, and compliance should guide your decision from the start. Overview of the most common business entities. The US offers several entity options for businesses. Each comes with its own tax treatment and regulatory implications. Sole proprietorship, simplest structure. No legal separation between owner and business. All income is reported on the individual's tax return. No liability protection. Partnership, two or more owners. Income flows through to partners' tax returns. General partnerships offer no liability protection unless structured as LLPS. Limited liability company, LLC, offers liability protection and flexible taxation, can be taxed as a sole proprietorship, partnership, or corporation. S corporation, pass-through entity with restrictions, limited to 100 shareholders, must be US persons, one class of stock, avoids double taxation. C corporation, separate legal and tax entity, subject to 21% corporate income tax, ideal for businesses seeking outside investors or long-term reinvestment. Understanding how each structure impacts your taxes and risk exposure is key to making an informed decision. Tax considerations for each structure. Each entity type has pros and cons for tax planning. Sole proprietorships and partnerships. Profits pass through to personal tax returns, subject to self-employment tax, up to 15.3%. No corporate level tax. LLCs can choose how to be taxed. Default is passed through but can elect to be taxed as an S Corp or C Corp. Offers strategic flexibility. S corporations allow owner employees to split income into salary and distributions, potentially reducing self-employment tax. C corporations, subject to 21% federal tax. Profits distributed as dividends are taxed again on personal returns, double taxation, but offer the most tax deferral opportunities. For growing or foreign-owned businesses, forming a C Corp can provide better scalability and investor appeal, despite the potential for double taxation. Choosing based on business goals and ownership. When selecting an entity, align your choice with your current and future plans. Are you a solo entrepreneur or co-founder? Do you plan to raise outside capital or take on partners? Is your priority tax savings, liability protection, or global expansion? For example, LCs work well for small service-based businesses. S-Corp are ideal for US-based professionals wanting tax savings. C-Corp are the best option for startups seeking venture capital or foreign investment. Consulting with a CPA or business attorney can help tailor your structure to fit your strategy and avoid costly restructurings later. Compliance and ongoing requirements. Each entity comes with different filing and compliance obligations. Sole proprietors report income on Schedule C. LLCs and partnerships may file Form 1065 and issue K1S. S-Corp file Form 1120S. C-Corp file Form 1120. Annual reports, registered agent services, and state-specific fees may apply depending on your state. Understanding and budgeting for these obligations will keep your business in good standing and avoid penalties. Conclusion plus expert tips. There's no one-size-fits-all business entity. The best choice depends on your vision, structure, and tax goals. Start with strategy and let that guide your decision, not convenience. 3 key tips to choose the right business structure. Align your entity choice with long-term tax and funding plans. Choose an LLC for flexibility or a C Corp for growth and investors. Revisit your structure annually as your business evolves.